Hi Dan. So, is equity release safe?
Well, I would always say that as long as you speak to a properly qualified and experienced advisor, then equity release should be a safe proposition for you. We are directly authorised by the Financial Conduct Authority, which is the government watchdog which oversees everything within financial services pretty much. So we have to meet certain standards of integrity and training and so forth. We're also voluntarily members of the Equity Release Council. Now, this is an extra set of standards that are arrived at across the industry. The Equity Release Council used to be called Safe Home Income Plans, so the SHIP scheme, and it's set up to protect the interests of equity release plan holders. But what it's actually done is with its council made up of industry specialists, it's driven a lot of innovation across the industry and a lot of protection. So it's brought in things like the no negative equity guarantee. Now, equity release had a lot of bad press in the old days, where people would owe more than the value of the house, or there would be the shared appreciation schemes where the banks seem to be profiteering on the back of companies, of people's plans because of the increase in property prices. Well, the no negative equity guarantee means that as long as a house at the end of the day is sold for a fair market value, even if the property market has crashed and the compound interest on the loan has grown to be more than the value of the property, that the lender can never come back to the families looking for money. It can never pass a debt onto the estate. So the worst case scenario is a zero balance. But speaking to an advisor, we can help you manage that so the zero balance is the least likely option. Okay.
So I suppose in those back in the early days, wasn't there a product once where you could draw the cash down to put into an investment which was meant to generate enough income to service the mortgage?
It was, yes. That was the income plans have largely disappeared now. There has been a really good version of that up until recently, but that's not available at the moment, which involved taking a whole series of small drawdowns. Now, of course, we can still do that on a flexible basis, but it's not based on an investment. It's not risk-based. What you're essentially doing is taking small amounts of your equity release each year or each 6 months, however much it suits you, to help supplement income over time, to maybe just reduce the shock of moving from an employed income to a pension income. But that can be flexible, but that is not based on an investment. It's purely taking a loan that would normally be available as a lump sum in smaller bites. It can also help save interest.
So I suppose the product I was referring to there was it could be possibly more aggressively sold to a potentially vulnerable customer there, but the risk would always be that the investment doesn't perform as well as the underlying mortgage interest rate, leading to potential financial catastrophe, which I think happened. And I suppose your industry suffered for many years off the back of those type of practices.
Yeah, absolutely. There were several schemes out there before equity release was so tightly regulated, that would hold out the hope of unrealistic profits to clients, and not stress the fact that actually the capital, far from not turning a big profit, but the capital is actually at risk and may be lost.
Yeah. Okay. Well, it certainly sounds like things are in a much better place. So thank you for that, Dan.
Thank you.